Mutual funds are very common today, and most of us invest our money in them. A mutual fund is a managed fund where money is pooled from investors and is invested in various securities like stocks, bonds, and debt. There are 44 AMCs and hundreds of mutual funds available in the market, and many of us lose money just because we choose the wrong funds. In this video, we will look at 7 key factors that should be considered for picking the right mutual fund. Let's get started. First in the list is setting your goals. Ask this question to yourself. What is your investment goal? Why are you investing this money? Is it growth, stability, or you just want to park your money somewhere safe? Your investment goal plays a very crucial role in deciding which mutual fund to choose. If you want your money to grow over time, then equity funds are definitely the best choice. But if you want to park your surplus money for a short duration, then liquid debt funds should be your first choice. Second key factor is the risk-taking capacity. Every investor has a different risk tolerance. It is crucial for you to determine your own risk-taking capacity, as risk tolerance depends on various factors, hence it can change at different stages of life. You should always question yourself. How much risk can I take right now? What are my current commitments and responsibilities? Based on your risk-taking capacity, mutual funds can be filtered further. Debt and hybrid funds are less riskier as compared to equity mutual funds. But then the chances of your money growing are higher in equity funds as compared to debt funds. Third factor is the time horizon. For how long you can stay invested. Depending on your goals, you have to decide for how long you have to invest your money in mutual funds. For equity mutual funds, generally the time period for staying invested is 3 years or more. Whereas for debt mutual funds, the time horizon should be at least 1 year. Time horizon is an important factor for picking the right mutual fund, and you should stay invested in a fund for suggested time in order to get good returns. Fourth on the list is expense ratio. As a mutual fund investor, you will have to bear the fund management costs charged as expense ratio by the fund houses. So there are generally 2 types of mutual funds: regular funds or actively managed funds, and direct funds, also called as passively managed funds. Regular funds are actively managed by fund managers and the expense ratio is generally higher, whereas direct funds are not actively managed and hence the expense ratio is less. Although at first it might not seem to be an important factor, but a 0.5 to 1% difference in expense ratio makes a very big difference in the long run. Consider you invested 10 crores via SIPs in 20 years in a regular mutual fund, and now think of the additional money you have given to the AMC just by choosing a fund with 1% more expense ratio. Some difference, right? So it is generally advised to choose mutual funds with low expense ratio for the long run. This is the reason why investors prefer direct mutual funds over regular funds. Few investors believe that regular funds perform better as they are actively managed. Hence, you should always compare the past performance of both regular and direct funds before picking the right fund. If you are considering to invest in index funds, then extra expense doesn't make sense as index funds don't require any substantial active management. Fifth factor in the list is tax benefits. Are you looking for tax exemptions from your investments? Then ELSS, Equity Linked Savings Scheme funds, are the only choice you have. ELSS funds are equity funds that offer tax benefits under Section 80C of the Income Tax Act of 1961. You can avail tax exemptions of up to 1.5 lakhs per financial year from your annual taxable income. Now the sixth factor for picking the right mutual fund is AUM, Assets Under Management. You should definitely consider the AUM of the mutual fund while picking the right fund. AUM tells about the size of the mutual fund and AMC's ability to manage larger investments. A larger AUM may indicate stability and trust of investors in that fund. It is also essential to ensure that fund size doesn't negatively impact the performance of the fund. Last but not the least in the list are exit load and lock-in period. Exit load is the fee charged by fund houses from investors at the time of exiting the mutual fund. This fee is chargeable only if the investors exit within a short period, generally 7 days for most mutual funds. Similarly, lock-in period is the time period for which the investors must remain invested in the fund. ELSS funds have a lock-in period of 3 years and some funds have no lock-in period at all. You should look for funds with minimum exit load and lock-in period. These were the 7 key factors that you should definitely consider before choosing a mutual fund. Remember, investing is a journey with many highs and lows, but it definitely gives great rewards if right decisions are made at the right time. So choose wisely, and if you liked the video, then do subscribe to Rupee Guru for more such videos on investment and money.